With so many firms posting earnings over the next few weeks, which ones have historically gotten the biggest bump up or the biggest slide down after reporting? Dominic Chu takes a look.
Earnings reports often drive volatility for the companies reporting. Among the best performing stocks in the S&P 500 on earnings day is beverage company Keurig Green Mountain. Over the last 8 quarters, the maker of single-serve coffee pods and home brewing machines has risen an average of 12% in the trading session immediately following its earnings report. It was helped along by a huge gain earlier in the year after announcing a big investment by Coca-Cola alongside its earnings report. Among the worst performing stocks is office supply retailer Staples, which has fallen an average of 6% after each of the last 8 earnings reports they've had. While those two companies are among the most volatile, it's the bigger sectors and stocks that will get a lot of attention this week.
If you look at the way the S&P 500 is kind of constructed, it's financials, infotech, and consumer discretionary. Every one of those is expected to have very powerful double-digit earnings growth in the next quarter, which will be kind of a really perfect situation for a broad-based, strong market.
Tech and financials are especially important because they are the 2 biggest sectors in the entire S&P 500. Large tech companies like Intel and Google, as well as banks like JP Morgan and Bank of America, could help set the tone for the rest of earnings season. Each reports earnings this week.
Earnings do matter, and they matter greatly. So I think it is something very important to watch, not just the earnings as they were for the third quarter, but what the companies propose for their outlooks year-end in 2015.
Many experts believe that earnings growth will be there, but whether it's enough to carry the entire market higher remains to be seen. Bank and tech earnings could go a long way in shaping things over the next few weeks. For Nightly Business Report, I'm Dominic Chu.
So how much of an effect will earnings have on this already volatile stock market? Let's get some thoughts from Joe Duran. He's CEO of United Capital Financial Advisors. Joe, as between the actual numbers and as opposed to what CEOs may say about the future, which has the greater potential to shake the markets over the next 3 weeks, the numbers or the words?
By far the words. I think what you'll find is people really don't care about what's been because it's been, and care a lot about what will be. And the stock market is a gauge of the future. So absolutely, what they say about the future is going to drive what happens for the next month or so.
Joe, tell us a little bit about these 2 big sectors that we're going to be hearing from this week. The financials, where we have Citigroup and JP Morgan reporting. We have technology. Intel is just one of them. What are they going to tell us about the health of these sectors and the health of the U.S. economy?
I think what they're going to tell you 2 things. One, are they going to use all of the new macro things that have been happening from Ebola to oil prices to the collapse, the increasing dollar, as an excuse to prepare people for bad news? That's the one big concern that everyone has. And second, are they going to sell through it? So the banks, they've had a very interesting interest rate environment. If they've been hedging in the wrong way, that's a problem. Intel derives half its income from overseas. The rising dollar could have a big impact on their future sales. So what they say about those 2 things in the future are going to have a big impact on how the market reacts. So those big bellwethers, how those CEOs react to these big macro changes is going to be very telling of whether we should worry about the next earnings report.
So is the market vulnerable? Let me pose it this way. Do you think that the CEOs will be very cautious in their forward guidance because of all the things you just mentioned?
I absolutely think that they have reasons and ability. And remember, CEOs like to outperform.
Sure.
And so if they have a good reason and a good set of excuses, for example, Intel could very well say the weakness in China and everywhere else allowed us to hit the numbers, and we expect to hit them in the future, but open the band for a possibility that there might be some surprises that are not positive. That tone, I think what you're going to see is a wider range of possible outcomes. And as you become less confident in the outcome, you become less certain, you get higher volatility. And that, I think, is what we're seeing now in the market.
Do you think investors are really going to be paying attention to what these CEOs are saying, in the sense that they already know that Europe is a problem, they already know China is weak? The details from each individual company, does it really matter that much, or is that already priced into the market?
I think a lot of it's priced in. That's what we've been seeing. But I think you have to remember, we've had this very big stealth correction. The Russell 2000, the smaller companies, already down 13, 14%. The big cap names have held up really well. And what we're going to see now is, how big is the impact going to be across, and are we going to have the first time in 4 years a 10% correction? I think earnings matter a lot. The words of the CEOs matter more. What the Fed is doing is even more important, and what actually happens with the economy is even more important. So all of it's intertwined, and we're at an inflection point clearly with the Fed stepping away, where earnings have to be able to keep up even with the Fed stepping away.
You pose the question, are we going to have a 10% correction? Where do you stand on that? Is that the next big headline for us?
I think it's going to be very odd if we don't get to 1,800 on the S&P. I think it's a natural progression point. There's a lot of support there. So my suspicion is we'll be probably flat by year end, which is not anything anyone wants to hear, basically slightly up single digits, but the volatility will be higher. And what we tell everyone, especially our most, we take care of our clients' entire net worth, so we tell them, look, we've had an incredible Goldilocks environment where the economy's been okay, stocks have done great, the Fed's been there to protect us, the Fed's stepping away, we're going to go back to a normal environment, 10% declines every couple of years. We've had 4 years since we've had one. That doesn't mean you should go to cash. It just means you should be prepared for it in your portfolio.
All right, Joe, very clear. Thank you very much. We appreciate it, as always, you're being with us. Joe Duran of United Capital Financial Advisors.